Hey, welcome. Today we're diving deep into a financial product that's built for one main reason, to try and generate monthly income, especially when the market feels a little tricky. It's called the SBAR ETF, and it uses something called a barrier income strategy. We're going to break down exactly what that means, how it works, and what to watch out for, using the fund's own materials as our guide. So let's get right into it.
Okay, but before we go any further, we have to get this out of the way, and it is incredibly important. This is for informational and educational purposes only. We're dissecting the source material to help you understand a concept, but this is absolutely not, under any circumstances, investment advice. You should always do your own homework and talk to a qualified financial professional. All right, let's continue. All right, let's set the scene. We're starting with the why. Why do products like SBAR even exist? It all starts with a common problem for investors. And really, it all boils down to this single question. For, a very long time now, investors have been in a tough spot. If you're looking for a steady paycheck from your investments, where do you even look when the traditional places just aren't paying out like they used to?
Yeah, that's the thing. The classics, like bonds and other fixed income investments, they haven't always delivered the kind of income that people need or want. And that exact challenge is what has spurred the financial world to get creative and design products that are, frankly, a lot more complex. So, here's what we've got on tap for this explainer. We just talked about the search for income. Next up, we'll introduce the SBAR ETF itself. Then, we get into the really important part, how these barrier options work. After that, we'll look at the potential upsides, and last but certainly not least, we are going to talk about the risks involved.
Okay, moving on to section 2. With that problem in mind, the search for income, let's see how this specific product positions itself as a potential solution.
So what exactly is SBAR? Well, according to the source material, it's an ETF, an exchange-traded fund. That just means you can buy and sell it on a stock exchange like any other stock. Its whole mission is to provide monthly income, and its tool for doing that is selling something called barrier options. Now, we're going to tear those apart in a second, but really pay attention to that last phrase, defined risk parameters. That idea is totally central to its entire strategy.
The big idea here is that it's supposed to be something different in your portfolio. It's not designed to act just like your stocks, and it's not designed to act just like your bonds. The goal is to give you a unique source of returns that, in theory, could help diversify everything else you own. Okay, this next part is absolutely crucial. To really get what SBR is all about, you have to understand the engine that makes it run. So let's take a minute and break down how these barrier options actually work. So first, what's the official definition from the glossary? A barrier option is a type of custom contract, and the key feature is a preset threshold, which they call a barrier. This barrier is the make or break level that decides what happens when the contract ends. All right, let's make this way simpler. Picture a tightrope walker. The SBA fund is basically selling tickets to watch the show. That ticket money is the premium. They set up a giant safety net, say 30% below the tightrope. That's the barrier. Now, there are really only two ways this ends. Scenario 1, the tightrope walker makes it across, or maybe they just wobble a little, but they never fall all the way into the net. As long as the market stays above that negative 30% barrier, the fund just pockets the ticket money. That's its profit. Easy. But scenario 2, the walker falls. If the market drops below that 30% barrier by the time the contract expires, the fund has to deal with the consequences. It's now exposed to that full downside, just cushioned a little bit by the ticket money it already collected. Now, this is a super important detail. What determines if our tightrope walker falls? Well, it's not just one thing. The fund is watching 3 different parts of the U.S. stock market at the same time: large cap, small cap, and growth stocks. And that safety net, it's tied to whichever one of those 3 does the worst. So even if 2 are doing fine, but just one of them takes a nosedive and smashes through that barrier, the contract is triggered. Okay, so now that we get the mechanics, let's talk about the why. Why would someone want to use a strategy like this? What are the potential upsides, and how would it actually play out in different markets?
So the source material lists a few key benefits. First and foremost, that potential for monthly income from selling all those options. Second, that defined downside barrier we keep talking about, which gives you a clearer picture of the risk you're taking on. It's also operationally pretty simple for the investor. The fund does all the complicated stuff, like rolling the options, for you. And 2 big practical pluses: no K-1 tax form, which, if you've ever dealt with one, you know is a huge relief, and it has daily liquidity, meaning you can get in and out of it easily.
This table right here, this tells the whole story. Seriously, look at those first 3 rows. If the market goes flying up or just goes up a little bit or even goes down moderately, as long as it doesn't break through that negative 30% barrier, the outcome for the fund is pretty much the same. It collects the premium, the income. Your upside is capped, but that last row, that's the one you have to understand. In a severe down market, if that barrier gets breached, the fund fully participates in that loss. So that's the trade-off, right? You're giving up the potential for big gains in exchange for trying to get steady income, but you are still accepting the risk of a major crash.
Okay, let's move into our final section, and I'd argue it's the most critical one. With any product that's this complex, understanding the risks isn't just a good idea, it is completely non-negotiable. And we're going to kick this section off with a direct quote from the fund's own documents. An investment in the fund involves risk, including possible loss of principal. Let's just let that sink in. It's stated very clearly, you can lose your money. The source also outlines several very specific risks. First is derivative risk. Remember, options are complex derivatives, and there's always a chance they could be mispriced or that something else goes wrong. Then there's active management risk. A human team is running this, and they might not get it right. There's also leverage risk, because the fund can use leverage, which can amplify losses just as much as it can amplify gains. Since it also holds bonds, you've got credit and interest rate risk. And finally, something called new fund risk. SBAR is relatively new, so it doesn't have a long, multi-decade history to look back on. And here's another really important detail you can't miss. That safety net, the barrier, it only really matters at the moment of expiration. In between, from day to day, the value of your investment is still going to bounce up and down based on what the market thinks those options are worth. So don't expect a smooth ride, even if the markets seem pretty calm. Now, we've covered a ton of ground here, but this has been an overview based on the fund's flyer. If you want to go straight to the source and read all the fine print for yourself, the prospectus and all that, the provider includes this QR code in their documents. So, we'll leave you with this final thought. A product like SBAR is a perfect example of the kind of trade-offs investors face today. If you want to chase higher income, you often have to embrace more complexity and take on different types of risk. And that really brings us to the core question for any of us. How do you personally balance that desire for more income with the hard work it takes to truly understand the complex tools you might use to get there?